it was Greenspan that sort of married monetary policy with the financial markets, married economic activity with the financial markets, and out came the Fed put. Now fast forward last December at the Powell press conference, Powell said our policies work their way through financial conditions, either tightening them through wider credit spreads, lower multiples on stocks, or it eases them, vice versa. Well, there are a few different financial condition indices. Bloomberg has one, Chicago Fed has one, Goldman Sachs has one that has a bunch of different inputs, whether it's credit spreads or the VIX or stock prices and so on. And it sort of measures market conditions, implying that the easier the market conditions are, then more companies can get funding, maybe there can be more IPOs, blah, 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 can lead to quicker economic activity, a wealth effect, and potentially faster inflation, and the reverse being the case. So at the press conference, he was asked about the easing of financial conditions of late. And he said, well, financial conditions are no different than where they were in mid-December, the last time we met. Meanwhile, the Bloomberg Financial Conditions Index was at the easiest since February of 2022, before the Fed started raising interest rates. And then he kept saying, well, they're tighter than they were last year, but they're not tighter. So he just answered incorrectly. And like I said, I don't know if that was ignorantly or he just wasn't in the mood to push back or is looking at something else. I don't know. But I think he should have read the room a lot better than he did and paid attention to what's going on in markets much better than he has. Well, first of all, it's more nuanced of a soft landing, hard landing, because also a soft landing implies a soft recovery. So would you want a soft landing and a soft recovery of GDP growth of 1% like we had in 2022, or do you want a harsh recession and a sharp snapback, or is there potential for just a general malaise? And this debate is I think is way too premature in us really knowing. We've had, call it 15 years of interest rates that were a pancake, and then we went vertical in 1 year. Okay, so in a interest rate / borrowing dependent economy, where it was a lack of savings but reliance on borrowing that helped to generate economic growth. Well, this very higher, I was going to say very high, but let's just say higher, much higher cost of capital. The economy, every month that goes by and somebody's loan is coming due that needs to be refinanced at a higher interest rate, cash flows get allocated to interest expense as opposed to growth. So the economy is going to get chipped away by this higher cost of capital month after month, quarter over quarter. So for someone to come out and confidently say, we're having a soft landing, well, the U.S. economy's, the U.S. manufacturing sector is in a recession. The U.S. housing sector is in a recession. So to come out and now say, okay, it's a soft landing, well, maybe, but I think we're going to get chipped away here from higher interest rates that are going to stay elevated for a while. And while we may not have a sharp recession, I think a soft landing is not necessarily a good thing, because if we go to like just say zero growth or minus 1% and we rebound to plus 1%, is that a good thing too? That's sort of just lackluster growth, and that's what I see in this kind of environment for a period of time, because a higher interest rate environment in an economy that's been very dependent on low rates is a headwind. Yeah. And unless rates are going back to zero anytime soon, which maybe they do, but only in a deep recession will they go back to zero. I don't expect any sharp recovery anytime soon. I mean, let's take the auto sector too. So we talked about housing; it's in a recession. You have the auto sector; that's the other interest rate dependent part of the U.S. economy. Well, financing a car right now, a $50,000 car, which is the average price, is getting tougher and tougher. And especially when the median income in the country is 50 grand. So you have very important parts of the economy that are getting chipped away by this rise in rates. Now, I want to say there's a positive out there, and that's the reopening of China. That's a big positive, I believe. But it's a big positive for China, the Asian region, and mostly Europe. The US doesn't do as much business with China as those areas do. So I don't want to say this is all a negative. I just think it's the higher cost of capital is more of a deterrent to economic growth. But let's look at this globally. Just take a step back. Talk about housing again. We had major housing bubbles in Canada, Australia, New Zealand, parts of Europe, Sweden. A lot of these countries have floating rate mortgages. The much higher interest rates in a lot of these countries are slowing down housing markets in all these different countries. Those are big drivers of economic activity. So for someone to say, "Hey, it's a soft landing," and be confident today, well, again, we have a lot of months and quarters and potentially years to come of acclimating to a higher rate environment that is just going to slow economic activity. You know, the Fed had something called forward guidance. They said, let's just keep rates at zero for a while. And they thought that was somehow stimulative. Well, this is sort of the reverse of forward guidance. We're going to keep rates high for a while. And that could be a perpetual form of tightening. And again, because each loan that's coming due, whether it's or getting readjusted, whether it's somebody who had a 7-year ARM and this year is year 7, well, that homeowner is going to see a payment shock. Now, hopefully they've paid down some of their debt, they have higher equity in the home, and maybe it won't be so bad, but for some it's going to be a rate shock. If you're in the commercial real estate business, chances are, you know, you may not have rent that's going to cover any new debt payments this year that is on a loan that's coming due. If you're a business, floating rate debt that didn't hedge out, you're allocating more cash flow, as I said earlier, to interest expense. Starting in 2024, 2025, we're going to have a wall of maturities in high yield. A lot of high yield is shorter term in nature. So yes, by having rates higher for longer, all this debt gets repriced at higher levels. Some companies will be able to handle just fine, those with good balance sheets. And those that have taken on too much debt and have gotten over their skis are going to see interest expense shock in response to this rate shock. Again, after a long period of time of very low financing costs. If the economy continues to weaken, we'll roll over some more. The question is after the recession and when we get, we bottom out inflation, we get that bounce back, are we looking at a multi-decade 1% to 2% inflation trend? I don't think so. Breaking out inflation in between services and goods, there was nothing ever transitory about services inflation. Services inflation in the 20 years leading to COVID, ex energy, averaged just below 3%. Okay, 2.8%, but let's call it 3. Services inflation, core goods, average 0. And an average 0, well, technology is always a deflationary force, but has been since the history of time. But also what kept core goods prices at 0 on average was cheap labor out of China. Cheap labor in the US, where labor got a pretty small piece of the profit pie. Just-in-time inventory was another factor leading to 0 inflation. But now you have no such thing as cheap labor out of China. I think the wage story in the US, while certainly plateauing and now modestly decelerating, I think is going to be elevated for a period of time in terms of rate of growth. We have onshoring. That's just going to be more expensive. I think the supply side of commodities being challenged for the next 5 to 10 years is going to lead to higher commodity prices, and that services inflation, let's just say it just goes back to 3%. I think maybe it settles out at 4 because of higher wages. And goods prices, all you need is good prices to go up, 1 to 2%, and services prices going up maybe 4, and you're going to have 3 to 4% type inflation in the aggregate, rather than 1 to 2. And I think where you can get core goods prices that are going to be above 2%. But I think you have the ingredients for, and just-in-time inventory is dead. My mind is all over the place now. So that's going to lead to higher prices because you're going to have higher inventory. more working capital needs, less cash flow, higher prices. So another factor why goods prices are not going back to zero on a sustainable basis. So all in, I think a period of time of much less inflation than we've seen, but higher inflation than what we had seen pre-COVID.